The Sarbanes Oxley Act (SOX) of 2002 is a significant piece of legislation aimed at improving corporate governance and financial reporting standards in the United States. 1. Background. Enacted in response to a series of high-profile corporate accounting scandals, including those involving Enron, WorldCom, and Tyco International. 2. Objectives. Enhance corporate accountability and transparency. Strengthen internal controls and financial reporting processes. 3. Key provisions. A corporatus personae requires CEOs and CFOs to certify the accuracy of financial statements and disclosures in periodic reports filed with the Securities and Exchange Commission (SEC). Holds corporate executives personally accountable for the accuracy and completeness of financial reports. B. Independent audit committees. Mandates that public companies have independent audit committees composed of members who are not affiliated with the company's management. Requires audit committees to oversee the work of external auditors and ensure the integrity of financial reporting processes. C. Internal control requirements. Requires management to establish and maintain effective internal control over financial reporting (ICFR), to provide reasonable assurance regarding the reliability of financial statements. Requires external auditors to attest to and report on management's assessment of ICFR. D. Enhanced financial disclosure. Requires companies to disclose material off-balance sheet transactions and arrangements that may have a material effect on financial condition or operating results. Requires companies to disclose code of ethics for senior financial officers and any changes to such code. E. Auditor independence. Prohibits auditors from providing certain non-audit services to their audit clients to ensure independence and objectivity. Requires audit firms to rotate lead audit partners periodically to prevent familiarity and potential conflicts of interest. F. Criminal penalties. Increases penalties for securities fraud and other violations of securities laws, including fines and imprisonment for individuals found guilty of fraudulent accounting practices. 4. Augmentation. The Sarbanes Oxley Act applies to all publicly traded companies in the United States and requires compliance with its provisions. Public companies must implement internal controls and procedures to comply with SOX requirements and undergo periodic assessments and audits to ensure compliance. 5. Impact. The Sarbanes Oxley Act has led to significant improvements in corporate governance practices and financial reporting standards. It has increased investor confidence in the integrity of financial markets and reduced the incidence of corporate accounting scandals. However, critics argue that SOX compliance imposes significant costs on companies, particularly smaller ones, and may stifle innovation and economic growth.